In this video, I'm going to show you how I create automated trading strategies or trading algorithms and do it all without having to learn any technical skills so you can create your own automated strategies. So first and foremost, before I get into the how-to and show you, why would you want to create automated trading strategies? Well, if you look at the trading data worldwide of retail traders, there are roughly 9 million retail traders. And the vast majority, over 8.5 million, are trading some sort of technical analysis based strategy. And you've probably heard the statistic that the vast majority of traders blow their accounts within 90 days. So the vast majority, over 8.5 million people who are trading technical analysis, are losing. So if you're part of that crowd, if you're constantly losing or break even and you're not really getting by, and deep down you may know that the technical analysis stuff doesn't really work, then you may consider something like algorithmic trading. So in this video, I'm going to give you a breakdown of how I do it and show you the three-step process from data mining to stress testing all the way to trading in a portfolio. So let's get into the video. So the way I like to build algorithmic strategies is, first and foremost, you start with data mining. So what is data mining? Data mining refers to the practice of using statistical analysis and machine learning techniques to identify patterns, correlations, and anomalies within large data sets of financial market data, allowing quantitative strategies to develop predictive models and make informed trading decisions based on these insights. What that's basically meaning is we're looking at large parts of data that we pull from brokers. We are mixing it around. We are adding entry logic, exit logic. We're adding layers of indicators and a few other things to try and come up with a profitable backtest. So what you're looking at right now is me doing just that. I'm currently testing on the German DAX, which I'll trade through an FX broker or CFD, whatever you want to call it. And I have the ability to test lots of different entry logic. Basically, how do I get into a trade? Is it a volume-based? Is it a trend breakout? Is it a moving average? Whatever. And I'm testing lots of different exit types at the same time. And I'm also looking for confluence by adding in layers of potential things or potential strategies. And that's the first part of data mining. And within this whole process, obviously, there's a lot more that you can do. You can go into detail from the money management side of things, and you can filter all the strategies based on what's important for you. For example, some popular strategies to filter by would be annual return, winning percent, open drawdown, open equity drawdown, the actual stability of the strategy, so how linear is the equity curve, and a whole host of other things. But it all starts with you telling the machine or prompt engineering the machine to go and look for potential. So think of it like ChatGPT, but for trading. That's the first step in the whole process. And as you can see right here, I'm currently running a test, as I said, on the DAX, and we have potential strategies that are populating. There's currently 385. Now there's 386, and soon to be 387 potential strategies. Now, it doesn't mean these strategies would be added to my portfolio. It just means they're potentials for right now. Once we have strategies, the next step begins, which is essentially stress testing. And when I say stress testing, I mean robustness testing. The easiest way to think of robustness testing is to take the back-tested data that you have and you try to break it. And the ones that pass without breaking are the ones that are good potential strategies. Now, within robustness testing, it basically refers to a process where a trading strategy is evaluated under various market conditions, parameter variations, and data variations to assess its stability and performance consistency, ensuring it can function effectively when faced with unexpected market fluctuations or data irregularities. Essentially, it checks if a strategy is robust to changes in its input parameters and market dynamics, not overly optimized for a specific scenario. So here's an example of one of the stress tests of a potential strategy. This one is on the NASDAQ. You can see over the course of the last 5, 6, 7 years, it's profitable. It hasn't performed the best, but it's profitable. Now, one of the stress tests that we focus on is essentially shuffling the order of the trades. So we take all the data and then we tell the system to shuffle the order of the trades. Now, how does this bear impact to the actual strategy? Well, what we're going to do is run 1,000 different simulations by randomly shuffling the order of the trades. So, for example, the first trade could be the 10th trade, the 10th trade could be the 100th trade, and so forth. And we run 1,000 different simulations, and what you're looking at right now, the thick blue middle line is the initial equity curve, and all these other spaghetti lines is a variation of those simulations. And you can see about half performed better than the initial backtest, and half performed worse, and some were even not profitable. So what we're trying to do is we're trying to clean the data so that it's not reliant on the order of the trades. It may have had a really good 2 months where everything won, which attributed to a lot of the success of the actual strategy. So we're trying to break the strategy, and we're telling the system if it doesn't meet a certain criteria, then we won't pass it and it doesn't move on to the next stage. That's an example of trying to break your strategy. The last part of the process is to add all of your strategies that beat all of the stress testing and see how they would have performed in a portfolio. I'm a firm believer in diversification, basically trading like a hedge fund would trade. Hedge funds don't just buy Apple or Tesla. They buy hundreds, if not thousands, of assets in different verticals to diversify their risk. And I think just because we're retail traders, we shouldn't approach the market in any different way. So you basically put your strategies into a mix to see how they performed well together. And you can see one of the strategies here, another one of the strategies here, but how do they perform as a portfolio? And as you can see, this is a potential of how the strategies would have performed together in a portfolio. Now, obviously, you have to adjust for risk, you have to adjust for open equity drawdown and a handful of other things, but generally speaking, this is how I like to trade strategies, using a 3-step process, all algorithmic, and once the strategies are on an account, and once they're trading and they're live in the market, you don't necessarily have to touch them. You have a hygiene test every quarter to make sure that they're on pace and in line with what the back test data says. And as long as everything's profitable and everything's going well, you simply leave it. The vast majority of the time, I don't have to alter or touch the strategies on my accounts, on my prop firm accounts and my personal accounts for months, if not quarters. So that's an example, an overview of how I leverage algorithmic trading, how I data mine without having to code, and basically create automated trading strategies that trade for me in the market. If you're interested in this sort of stuff or want more information, you can leave a comment down below, or you can click the link somewhere wherever this video is, and you can find out more information there. Happy trading.